Hi, Daryl Kramer back with another Mortgage Minute. In the ever-changing and evolving landscape of mortgage financing, it's crucial to understand how external financing factors can influence mortgage rates. One significant factor is the bond market, both in Canada and south of the border in the States. So here's a breakdown of how bond yields impact fixed mortgage rates and why staying informed matters for your financial decisions. First off, what are bond yields? Well, they're essentially the return on investment for bondholders. So when investors buy bonds, they're lending money to the government or corporations in exchange for periodic interest payments and the return of principal amount upon maturity. The yield represents the annual return on these bonds expressed as a percentage of the bond's current market price. Now, let's take a look at how bond yield affects fixed mortgage rates. First is the correlation between bond yields and fixed mortgage rates. Fixed mortgage rates are closely linked to government bond yields, particularly the 5-year bond yield in Canada. This is because mortgage lenders often use these yields on these bonds as the benchmark to set their interest rates for fixed rate mortgages. So when bond yields rise, the cost of borrowing for lenders increases, which in turn raises fixed mortgage rates. Now conversely, when bond yields fall, borrowing costs decrease, which lead to lower fixed mortgage rates like we're seeing today. Economic indicators, so in the bond yields, they're influenced by various economic indicators, inflation rates, economic growth, and central bank policies. So as expectations rise, bond yields rise as investors look for higher returns to compensate for the eroding purchasing power. So this rise in yield usually translates into higher fixed mortgage rates. Similarly, if the central bank signals that it will raise interest rates to combat inflation, bond yields may also increase, leading to higher fixed mortgage rates. So next up is market sentiment and risk. Bond yields can also be affected by investor sentiment and risk appetite. So during times of economic uncertainty or financial turbulence in the markets, investors may flock to safer assets like government bonds, which then drive up bond prices and push down yields. In such scenarios, fixed mortgage rates may decrease as the lower bond yields make borrowing cheaper for lenders. Now conversely, in a booming economy, investors might seek higher returns from riskier assets. This pushes up bond yields and causes fixed mortgage rates to rise. Now finally, we have to look at the Canada and US bond yield dynamic. While Canada and US bond yields often move in tandem due to the interconnected nature of the global economy, differences in economic conditions and central bank policies can lead to variations between the two countries. For instance, if the US Federal Reserve raises interest rates more aggressively than the Bank of Canada, US bond yields may rise relative to Canadian yields, potentially leading to a wider spread between US and Canadian fixed mortgage rates. So you may be asking yourself, what does all this mean for you? Understanding these dynamics can help you make informed decisions about your mortgage. If you're considering a new fixed rate mortgage or you're looking to refinance, keeping an eye on bond yields and related economic news can provide insights into the future rate trends. It's also advisable to work closely with your mortgage professional to navigate these fluctuations and secure the best possible rate and mortgage product for your situation. Bond yields play a key and pivotal role in shaping fixed mortgage rates. By staying informed about their trends and implications, you can better manage your mortgage strategy and make decisions that align with your overall financial goals. As always, feel free to reach out if you have any questions or need assistance with your mortgage planning. I'm always here to help. That's all for today, folks. Bye for now.